Hi everyone. Tonight we are going to learn about Chapter 4, which has to do with consumer equilibrium and market demand. So here's a couple relevant quotes, especially at this time in the semester. So it says, character consists of what you do on the third and fourth tries. So don't give up. And the most difficult thing is a decision to act. The rest is merely tenacity. And that is by Amelia Earhart. So you're this far in the semester, don't give up. Okay, so we're going to review a little bit some of the things we learned about last week, try to tie them into the idea of budget, into demand, and we're going to talk about the factors that affect demand. So first of all, a review. These are isoquants or iso-utility curves. All of these are consumption bundles, points on the groups of goods that the consumer has satisfaction, receives satisfaction from. The blue line is a budget line. We studied that last week. In this case, the person's budget is $5 per week. So we create the budget line by doing the y coordinate here, which is 0 and 10. And we get that by the fact that tacos are 50 cents a piece. So she spent all her money on tacos. It's not what she likes, but that's what she can afford. That would give us that point. This point down here would be if she spent all her money on burgers. Burgers are $1.25 a piece, $5 budget. She could afford 0 tacos and 4 burgers. That gives us a budget line. The point of tangency where the budget line and the utility curve meet, that is consumer equilibrium. That is an important point, and that is a test question. So consumer equilibrium, where the budget line and the utility curve are tangent. The problem with point B and D here is she cannot afford those products, those combinations of goods, because they don't fit her budget. The only thing that's $5 is every point along this blue curve. And so D is too expensive and B is way too expensive. On the other hand, point C doesn't maximize her utility. She could do better. So consumers are always going to buy the best quality that they can afford. So this doesn't maximize her utility because she could afford better. Okay, so going back to the budget line, this is our original budget line. We're now going to look at how a change in the price of goods like burgers and tacos affects this budget line. So in this case, what happened is the price of burgers decreases to $1. She still has a $5 budget, or he does, a $5 budget. So now instead of affording 4 burgers, he can afford 5. And when that happens, the whole budget line shifts. Still only afford 10 tacos. If he spent all his money on tacos, that would be 50 cents a piece. So that would be $5 there. And this is the new budget line, this line right here. So now there's a new point of tangency, and that means that that consumer has a new combination of goods that maximizes their utility. So it goes back to the idea of how can a consumer get more of what they want? Well, if the price of a good declines, then the consumer will buy more of that good. On the other hand, in this case, you have a dramatic change. In this case, you had your original budget line here. In this case, the price of burgers increases to $5. He only has a $5 budget, so he could only afford 1 burger. And the point of tangency there would be on this utility line of this skinny one right here, point C. So that would be a budget of $5 you could afford. That doesn't seem quite right. 1 burger if he spent all his money on burgers, or 10 tacos if he spent all of his $5 on tacos. And so that is the one combination that fits his budget line if the price of burgers were to increase. Shift to the left. So the law of demand is an important economic law, and then the law says as price increases, demand decreases. As price increases, demand decreases. So in this case, as price increases, this consumer can afford less, so demand is going to decrease. Okay. This is a scatter plot that shows the demand for steak. And so It just shows the downward nature of a demand curve. So demand curves always have a negative slope, meaning that as price increases, demand decreases. So at a very high, remember how it works, at a high price, you're not going to purchase very much. At a low price, you're going to purchase more. So negative slope of a demand curve. As price increases, demand decreases. Okay, so this gives you an idea of how budgets work. And budgets, they are going to use that to teach you about how to create a demand curve. So they're showing you kind of how to derive a demand curve. So you have Betty and Wilma. They wish to buy t-shirts and shoes. Betty has a budget of $600, whereas Wilma has a budget of $1,200. Using the indifference curve analysis below, determine prices for the t-shirts and shoes. For which commodity can you derive a demand curve? Derive the curve for Betty and Wilma. Finally, derive the market demand curve, assuming that they are the only customers. So let's see if I can get this right on the first try. So Betty has 600, while Wilma has 1,200. So at this point, if Betty has $600 and she could buy 40 t-shirts, that means that t-shirts cost $15 a piece. How did I figure that out? 600 divided by 40 is $15. So basically, and then if she could afford 20 pairs of shoes and no t-shirts, 20 goes into 630. So shoes are $30. So t-shirts are 15 and shoes are 30. So that's the price of the goods. In this point right here, you have the beginnings of a demand curve. So Betty gets utility from, and it meets her budget at this point A, so she could buy 30 t-shirts and 5 pairs of shoes. So that could be our first point on her demand curve. On this axis, we would put the price, and on this axis, we would put the quantity. So in this example, you have the same thing. So you have her purchasing 10 t-shirts and 10 pairs of shoes to fit her budget, and also that meets her utility. Wilma can afford more. I'm not going to work all the way through this because I only have 15 minutes, but this is a quiz. It's not a quiz question. It's a question on your homework, so you'll get to work through that a little bit. And by all means, if you don't understand it, drop in on Zoom or send me an email. I can help you. Okay, so let's look at how demand is forming here. I think I got my line off a little bit here. There we go. So if we look at, let me back up here. If we look at how we create a demand curve. So we have two individuals. This person, if you look at this black and white dotted line, will buy 2 burgers, will buy 1 burger at a price of $2, or they will buy 2 burgers at a price of $1.50. So they have 2 things that fit in their budget, or that is what they're willing to purchase. So there's basically 2 possible combinations there. This person, Beth, she only has a budget enough to buy 1 burger at $1.50. So if we add those together, at $1.50, we would sell a grand total of 3 burgers. So that gives us a point for our demand curve. And at $2, we would sell 1 burger. So all we need to draw a straight line is 2 points. So that is how we're creating our demand curve. So demand is created by measuring the quantities purchased at various prices. They make it so complicated, but all it is the quantity purchased at various prices. Okay. So the next thing we're going to talk about, and go back to this miserable budget line, is this idea of income. So a consumer has a budget, and they have to work within their budget, maximize your utility, and that's consumer equilibrium, and that's all good. We already learned that. So that's your original equilibrium. So what happens if we get more money? If we get more money, our income goes up, we can buy more stuff, and that's what we do. So you can create a new budget line, and the new budget line allows you to purchase a greater amount of goods. and look at the parallel nature of the original budget line, the original equilibrium, and the new equilibrium created by the increase in income. The other point they're trying to make, which is important, is this idea of normal goods. It's a term. Normal goods are goods for which when your income goes up, you buy more of them. So both tacos and burgers are normal because she increased her consumption of both tacos and burgers. We're going towards the right on the x-axis and increasing on the y-axis. So normal goods are goods for which our income goes up, we buy more of them. So, important thing to remember, the 4 factors that influence demand are price, income, price of substitutes, and changing tastes and preferences. This one has to do with the law of demand. As price increases, demand decreases. That is the #1 factor affecting consumer demand. What you and I purchase is price. Another factor that affects what we buy is our income. If you get more money, you're going to buy more stuff. Okay? And then the price of substitutes also affects consumer demand. So if 2 goods are equal in the eyes of the consumer, like hamburgers and tacos, if the price of one good decreases, you're going to buy more of it. That's the idea of the substitutes. And then the final one is consumer tastes and preferences. Consumers sometimes are fickle, and sometimes it doesn't matter what the price of a good is if it has some quality that consumers really desire. So you're going to have a little homework assignment on that one this week. Okay, so now they're going to talk about, it's just so confusing the way they say it. So the way they're going to call it is they're going to talk about movement along a demand curve, which really refers to a change in price. They call it a change in quantity demanded. The other thing that they say is when the demand curve shifts, you get a new demand that is created by increase in income or a change in the price of substitutes. That's called a shift in demand curve. Your book calls it a change in demand. Let me show you. So here we go. So these are 2 different demand curves. So let's say this is the demand for hamburger in 2017. Okay, at a price here, consumers are going to buy this particular quantity. Okay, if your income goes up in 2018, then you're going to buy more hamburger. The price did not change. So consumers will buy more of something if their income goes up. So 2017 and then 2018, we have more money, we're going to buy more hamburger or whatever the product is. On the other hand, this idea of a change in quantity demanded, as your book states it, is this point from point A to point B. And that is, notice in the same year, if the price of hamburger decreases, we're going to buy more of it. Either way, we're going to buy more. We can buy more if the price decreases, or we can buy more if our income increases. This is a change in quantity demanded. Now, this is a change in quantity demanded. This is a change in demand. I call it a shift in demand. Okay. Change in quantity demanded is point A to point B. Oh my God, it's so confusing. I call this a shift in demand. Your book doesn't call it that, though. I'll make everything so complicated. Okay, finally, in conclusion, what did you learn in this chapter? You learned about consumer equilibrium, the point where utility and the budget are maximized or equal. Law of demand, as price increases, demand decreases. Factors that affect consumer demand: price, income, price of substitutes, and consumer tastes and preferences. And then we learned about this idea of shift in demand, which is caused by a change in income. As your income increases, you buy more stuff. The last thing we didn't talk about is changing consumer tastes and preferences. And I don't have time to talk about that, but it's a fun one, and you're going to get a homework assignment on that. All right, well, take care, and I will see you next week.